If you waited for the 2025 Bitcoin crash to settle down before protecting your portfolio, this is your warning. The next shakeout can wipe out leverage, force bad exits, and turn a good long-term plan into a panic trade in hours. Right now, the market is already reminding traders how fast the pain can return. Bitcoin just ripped to $63,700, triggering the biggest short liquidation event since late April, while total crypto liquidations hit roughly $655 million and more than 104,000 traders got hit in 24 hours. That is not normal background noise. That is a stress test. And the lesson for 2026 is simple: survival comes before upside. In the next few minutes, you're going to get 5 practical lessons from the 2025 Bitcoin crash that can help you safeguard your crypto portfolio this year. Avoid the most common liquidation traps and keep yourself positioned for the rebound instead of becoming the rebound's exit liquidity. Number 1 is the most important, but the last one is the one most people ignore. Number 1, stop confusing a rebound with safety. Bitcoin's move back to 63,700 looks strong on the surface, but the same move just punished anyone leaning heavily the wrong way. About $504 million in short positions were wiped out in 24 hours, and that was the largest daily hit for short sellers since late April. That tells you something important. Price can snap violently in either direction, and a fast move does not mean the market is stable. It means the market is hunting. This is exactly why the 2025 crash still matters in 2026. People remember the chart, but they forget the mechanics. A sharp fall can create the illusion that the worst is over, and then a rebound tempts traders to size up too quickly. If your portfolio only works when price goes up in a straight line, it is not a portfolio, it is a bet. The practical fix is boring, which is why it works. Decide your maximum risk before volatility hits. Know how much of your portfolio can be exposed to crypto without forcing you to sell during a drawdown. If you need to rewrite your plan after every 10% move, you are not managing risk. You are reacting to it. And that matters even more now because the market is not just moving on price, it is moving on liquidations. But that is not even the full story. Number 2, respect leverage like it's a loaded weapon. The data from this morning says it all. More than 104,000 traders were affected by roughly $655 million in total crypto liquidations in just one day, and Bitcoin and Ether positions accounted for the bulk of forced closures. That is what leverage does. It turns a normal correction into a portfolio-ending event if you are overexposed. A lot of investors think leverage is only dangerous for degenerate traders. That is a mistake. Even a small amount of borrowed exposure can become fragile when prices move fast enough to trigger forced selling. And once forced selling starts, the market can turn on itself. The chart does not care that your thesis was right. The liquidation engine only cares whether you have enough margin left. So here's the lesson from the 2025 crash. If you want to survive 2026, use leverage with extreme restraint or avoid it entirely. If you do use it, keep the position small enough that a violent wick does not change your life. The goal is not to avoid every losing trade. The goal is to avoid one liquidation that destroys months or years of progress. And if that sounds dramatic, remember the numbers. 104,000 traders in a day. That is the market telling you to slow down. But there's a deeper lesson hiding underneath the liquidations. Number 3, don't rely on one side of the trade. The same market that crushed shorts also punished anyone who assumed the trend would continue cleanly. Bitcoin's bounce from below $60,000 was powerful enough to trigger huge short liquidations, but a fresh Iran-Israel flare-up pulled prices back on Monday. That is the kind of whiplash crypto investors must plan for in 2026. Sharp upside, sudden reversal, repeat. This is why concentration risk matters so much. If your entire portfolio is built around one coin, one narrative, or one outcome, you are one headline away from stress. Even when a token looks stronger, the market can still be trapped by broader trend pressure. CoinDesk reported that XRP steadied above $1.10 after bouncing from 4-month lows, but it remained trapped below key resistance levels even as ETF inflows and exchange outflows continued to build. Translation: accumulation can happen under the surface while price still looks weak. That's a useful reminder for any crypto investor. The chart you see today is not the whole picture. So how do you protect yourself? Build for outcomes, not predictions. If Bitcoin leads, you want to participate. If the market broadens, you don't want to be trapped in one trade. If volatility returns, you want enough flexibility to hold through it. A diversified crypto allocation does not mean buying random tokens. It means not letting one position decide your future. And the next lesson is the one that keeps people from making a bad market even worse. Number 4. Cash is a position, not a mistake. When prices are flying around and liquidations are exploding, many investors feel pressure to be fully invested at all times. But in 2026, that mindset can be dangerous. The market just showed that it can move hundreds of millions of dollars through forced exits in a single day. If you have no dry powder, your only option during stress is to watch. Holding some cash or stable liquidity is not cowardice. It gives you the ability to buy when others are forced to sell, rebalance when panic creates opportunity, and avoid becoming a seller during a drawdown. That is especially important after a crash year like 2025, because the emotional scar tissue lingers. People who were burned once often either freeze or chase. Both are expensive. Think of cash as your volatility buffer. It does not need to be huge, but it needs to exist. Even a modest reserve changes how you behave during the crash. Instead of asking, "How do I get out?" you ask, "What is actually worth buying here?" That shift alone can improve long-term returns, and that leads to the final lesson, which is the one most investors learn too late. Number 5. Your edge in 2026 is process, not prediction. The market is too fast, too headline sensitive, and too liquidation driven to survive on vibes. Bitcoin can rebound to $63,700 and still be vulnerable to fresh geopolitical shocks. XRP can stabilize above $1 and still remain below key resistance. Exchange outflows and ETF inflows can build quietly while the price action still looks ugly. In other words, the market can be right before it looks right. That means your job is not to forecast every move. Your job is to build a system that survives multiple moves. A good crypto portfolio in 2026 should have rules for position sizing, a plan for rebalancing, a limit on leverage or no leverage at all, and a cash buffer for volatility. You should also assume that the market can liquidate crowded trades fast enough to make smart people look reckless. Here's the simplest way to apply this today. Write down your maximum downside, your target allocation, and the conditions under which you would add, trim, or do nothing. If you cannot explain your plan in 1 minute, it is probably too complicated to survive a crash. The investors who make it through years like 2025 and 2026 are not the ones who predict best. They are the ones who still have capital after everyone else gets forced out. So if the 2025 Bitcoin crash taught us anything, it is this: protect the downside first. Keep leverage small or absent, diversify the risk, keep dry powder ready, and use a written process instead of emotional reactions. That is how you stay in the game long enough to benefit from the next recovery. If this helped, subscribe so you don't miss what's coming next, and drop a comment with the one rule you're changing in your portfolio this year. The key takeaway is simple. In 2026, surviving crypto volatility matters more than predicting it. This is general financial information, not personalized investment advice. Crypto is highly volatile, and you should make decisions based on your own risk tolerance and circumstances.